Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Ronald Stöferle. Ronald is a chartered market technician. He was on with us last year, actually, to discuss In Gold We Trust, which he has co-authored with Mark Valek. But Ronald's background in the financial markets for some time, but he is perhaps, not perhaps, I think he is best known for his 6 benchmark reports called In Gold We Trust. It has drawn international coverage and on CNBC, Bloomberg, and Wall Street Journal, The Economist, and the Financial Times, very prestigious publications, of course. So, Ronald, thank you so much for joining us again.
Thank you very much, Jay. I'm sorry, but I have to correct you, but it's also already the 13th edition of the In Gold We Trust. I'm writing it for quite a while now, and actually we hit at a new all-time high, at least in terms of the length of the report.
Oh, okay. Well, we'll have to update our bio here, won't we? That is a bit embarrassing to realize you were doing it for that long. I think in more recent years is when you started really getting a lot of coverage. Maybe since gold really hit its highs in 2011. Well, we're very short on time, and I as I went over your book, I said, goodness, we probably should have you on a number of times because almost every chapter in this book is, would be the content for a 25-minute segment. So I want to start out, though, by asking you to tell our listeners how they can get a copy of it. Now, this is corporate supported, and one of our sponsors, Novo Resources, I note, is one of your sponsors. So this is free of charge, and people can actually download it, I guess, can't they? And where do they go to do that?
Yes, actually, the report is available totally for free in a compact version, which is still 110 pages, and then there is also the extended version, which is 340 pages. Mm-hmm. So it is quite an extensive read, but there are just so many interesting things to cover these days that we thought, okay, we have to write such a massive report again. It is available for free. Just Google In Gold We Trust 2019 on our webpage. It's free to download it. ingoldwetrust.li, which stands for Liechtenstein, and there you can also subscribe for all of our other publications. The report, we've got, as it's a massive investment on our side, there are 15 people involved with crunching the numbers, with proofreading, editing, getting all the data. So we've really got the cream of the crop in the gold mining space and in the gold space in general that support us, because we said, we really want to get the word out, also make a positive case for gold, how gold fits in your portfolio, not only for people, I would say, in our camp, but also for the generalists. So we write quite extensively about the portfolio characteristics of gold, for example, how gold performs in different stages of a recession. So just invite all your listeners to study the 2019 edition. I think it's really worth the time.
Well, there's so much there, and it really deals with geopolitical aspects of gold. Let's get into some of the topics, and we'll do the best we can. First of all, I noticed that you start out your 2019 annual report on gold with the observation that trust of all kinds of institutions is not what it used to be. Whether it's the news media, churches, big business, governments, central banks, what have you, there is a decline in trust. So talk to our listeners about why that is so important if you're going to have a coherent, thriving society.
Yeah, I mean, I think trust is often underestimated. Yeah, we all take it for granted, but all human interactions are based on trust. Whether it's with your partner, with your business partner, whether you jump a plane, you trust the pilot that he's doing a good job, and you trust the airline company that they've been servicing the plane. So trust is really essential in every part of our life, and it seems that this trust is crumbling at the moment in media, in politics, in society in general. We are seeing that People are questioning beliefs. They are questioning the democracy itself. We're quoting quite a lot of studies saying that actually the millennials, they don't care about democracy anymore. They want to have a strong leader, either on the very right or on the very left side of the spectrum. It is no coincidence that populists win elections all over the globe. So I think this crumbling trust is unfortunately a secular trend that we're in the middle of, and where there's still quite a lot of trust is central banking, is the US economy, and is the US dollar. But the interesting thing about trust is it's highly asymmetrical. So it takes years, decades, sometimes centuries to build up that trust, but that trust is broken and lost very, very quickly, sometimes just in a moment. So from my point of view, at some point the markets will find out the emperor has no clothes. They will lose trust in the US dollar, in the Federal Reserve, and I think that gold should be a pretty good safe haven in that environment.
Well, we certainly aren't cheering for that loss of trust just so we can have, so we can gain wealth by owning gold. As a matter of fact, I think we want to own gold as a safety precaution against those kind of events that you're talking about. But to what extent, Peter, do you think that this lack of trust is playing into the hoarding of gold by central banks? You notice you talk a lot and provide a lot of data and evidence that China, Russia, central banks, especially those that are adversarial, central banks of adversarial countries to the United States, seem to be building up their gold reserves. Is this a repercussion of a lack of trust geopolitically, would you say? Yeah.
I think it's clearly a sign of the de-dollarization that we're writing about for quite some years now. Last year, we have seen that central banks bought 657 tons of gold, which is the highest amount of purchases since 1971. It is not only Russia, China, India, Kazakhstan, Turkey. It is also some European Union countries like Poland or Hungary. Just a fantastic quote by the Hungarian central bank about its first gold purchases. They say, in normal circumstances, gold has a confidence-building feature. It may play a stabilizing role and act as a major line of defense under extreme market conditions. In addition, gold continues to be one of the safest assets which can be related to individual properties such as the limited supply of physical precious metals, which is not linked with credit or counterparty risk. And I mean, that's the Hungarian central bank is saying that. It seems that they're readers of the In Gold We Trust report, but it clearly shows that on an international level, I think there's also this loss of trust that we're seeing, and this repatriation trend that is picking up. So Germany, Holland, but also Austria repatriating the gold holdings, bringing the gold back home. That's a clear evidence of this loss of trust.
For sure. So a lot of the European central banks are adding gold, physical gold, if either going out and acquiring more gold, or they're having their gold repatriated, which is, as you suggest, is certainly suggesting a lack of trust. Well, China is doing a lot of other things too, besides importing gold. They're certainly setting up the One Belt, One Road structure, which is just a huge infrastructure that they're building up that allows trade for a number of countries, and I think the United States is one of the few countries that is really trying to stay away from that kind of from hooking up with China in its One Belt, One Road. Like Canada is involved or potentially involved. Australia, of course, down in that part of the world. But do you see this is also Russia is very much a part of that. Russia can provide the raw materials. China, of course, with its population, has a demand for those raw materials. What do you make of all the things that are going on, alternative ways to trade and move money around, of course? Maybe Bitcoin or some of those cryptocurrencies come into play somewhere down the road?
Well, when it comes to China, we dedicated quite a large chapter about China and especially the Chinese gold market in this year's report, because for the very first time, we're also publishing the report not only in German and in English, but also in Mandarin. So this is quite a big step for us, because China is at the moment the biggest producer, but also the largest consumer of gold. And I think that the whole de-dollarization topic. I think that many commentators are a bit naive and think the renminbi will replace the US dollar as the world reserve currency very soon. I think that's Rick Rule once said the US dollar is a lie, but it's a very, very liquid lie, and just the dimensions of trade and settlements in the US dollar compared to the renminbi, and the depth of the capital markets and the sophistication of capital markets, it clearly shows me that that's still a long time in the future that we'll really see a competition from the renminbi to the US dollar. However, we're seeing so many small steps that actually the Chinese want to diversify out of the dollar. They're building up gold reserves. They're not investing into US treasuries anymore. On the other hand, they're very active when it comes to gold. As I've said, they became the by far the largest producer a couple of years ago, and they will continue to be the largest producer. They are building their infrastructure for gold trading, but also for the oil trade. Just to give you one number, Jay, the Chinese introduced the Shanghai Oil Future only last year in spring, and now they already got 12% market share in the oil market, which is by far the biggest commodity market. So that's an enormous success. And I think that the whole trade war that is going on, when I'm talking to Chinese colleagues, and I'm quite often in China nowadays, it seems that they're pretty relaxed about it. They know that Donald Trump wants to win an election in 2020, and they know that they don't have to care about any elections. So
over there,
So I think they are really playing the long game, very strategic thinkers, and I think the One Belt, One Road, there's this Chinese proverb, one generation builds the road on which the next one drives. And I think this perfectly describes this long-term thinking of the Chinese. And the Belt and Road Initiative, it encompasses 68 countries and regions, which are home to around half the global population. And it currently generates around 1/3 of global GDP. So it is a huge infrastructure project. I think there's lots of moving parts, but from my point of view, gold plays a role in that One Belt, One Road. We for example, we're showing the gold reserves of the central banks and especially the gold deposits of all the participants of the Belt and Road Initiative, and it's massive. So I think this is definitely something to watch. And of course, the Chinese, trade is one of the most important peacemakers or peacekeepers, probably. So I think it's also to increase the cooperation between China and those other countries.
Indeed, and it seems the United States isn't too keen on having that happen. They want to control the sea lanes, the South China Sea and so forth. But let me ask you, Peter, so the Shanghai Oil Exchanges capture 12% of the market, you said, of the oil market. If they can continue to grow that oil market like that, might that not underpin their own currency? Yes
and no. I think that many there's I think many commentators making the case for significantly lower renminbi, and actually many people think that it will rise significantly. I think where we're standing at the moment is just the level that the Chinese wants to see. I think the devaluation that we have seen over the last couple of weeks, this is definitely something that they try to scare Donald Trump. But everybody who thinks that actually they want to be the trade and the reserve currency with some sort of a gold-backed renminbi, I think this is a bit naive, because I think a strong renminbi is the very least that they want. Because at the moment we are seeing definitely a weaker Chinese economy. Essentially, we're seeing a global slowdown in 95% of all countries. Economic numbers are coming in weaker than 1 year ago. But and this is important, the Chinese started this monetary U-turn already in fall. So they lowered the reserve requirements, they put in massive fiscal stimulus, and so I think the bottom in commodity markets and also in the gold market is also kind of influenced by this Chinese U-turn. So actually they were the first ones, and now we're seeing this massive U-turn by the Federal Reserve with lowering rates 2 or 3 times this year, with ending or finishing quantitative tightening much earlier. And I think sooner or later we will see new rounds of quantitative easing, perhaps at some point even negative rates, MMT, you name it.
Well, it sure seems like that's what's heading our way, for sure. You had a couple chapters devoted to Bitcoin. On pages 242 through 254, you address gold versus Bitcoin and ask the question whether the two linked together might be stronger. Could you share some of your thoughts on that topic?
Yeah, absolutely. I mean, we are following Bitcoin and the crypto scene for many years already. So already 4 years ago, we wrote the first time about Bitcoin, and I think there are many similarities between gold and Bitcoin. And actually, Bitcoin was kind of designed as a digital gold, because there's the stock to flow ratio is very similar. So you've got a natural built-in low inflation. I think it's no coincidence that you're mining for Bitcoin, that the logo of Bitcoin is actually a gold coin. And from my point of view, we have seen this crypto winter, but now Bitcoin is up at 9,000 again, but it's still no big topic. And actually, my thesis is that the cycles in Bitcoin are so much shorter, so those boom and bust cycles, because there's almost no debt involved. And normally in a normal financial market crisis and bull and bear market, there's much more debt involved, and this debt has to be restructured or written off and so on. So those bear market phases take longer. But with Bitcoin, we have seen it has been a very brief and brutal bear market, and now we're up again. So from my point of view, Bitcoin makes sense from a portfolio point of view. There's a very little correlation between gold and Bitcoin. We're actually doing a fund now where we're doing a rebalancing strategy between gold and Bitcoin, and yeah, we're pretty positive when it comes to competing currencies. Competition makes every market better, so why shouldn't it make currency markets better?
Well, this is something I'd certainly like to talk to you about more, but my engineer is telling us we have less than 3 minutes left. So let me just ask you, since we cover gold stocks, I write about them and research them. You said in one of your chapters, anyway, on page 263, you raised the question, after the creative destruction, a bull market, ? What are your thoughts about the gold share markets now, and do you think they could be poised for something more positive on the upside in the years to come?
Yeah, I'm super excited about the outlook for the mining stocks. I think we've seen massive creative destruction in the sector. I think that the companies really, they most of them did a tremendous job just cleaning their balance sheets, getting leaner, and we've seen the recent M&A wave clearly reinforces our positive assessment. And actually, I think at the moment we're seeing the highest leverage on rising gold prices ever. So if gold goes to 1450, 1500, and this can happen definitely this year, I think we will see a great run in the mining stocks. And actually, Jay, nobody from the generalists at the moment is invested in gold, and especially not in mining stocks. And just the last thing that I want to say, we're talking to lots of wealth managers, institutional players, and so on. Fourth quarter 2018 was a big warning shot. So basically every asset class was down, but gold was up 7% and mining stocks were up 14%. So gold reappeared on the watch list of many, many really investors with deep pockets. And I think as soon as we're above this resistance zone, I think there's going to be lots of momentum kicking in.
All right, we'll have to leave it at that. That's certainly in concert with what Michael Oliver told us in the first segment of today's show as well. We can get through that 1360, 1350, 1360 level. We could see a very rapid rise from there. Peter, I want to thank you so much for spending your time with us. Lots of things to talk to you about. I want to get your opinion on a lot of other topics if we can have you back sometime in the near future.
Anytime. Thank you very much, Jay.